see if I can muddy the water even more so for you. Actually, I hope I clear it up. Okay, we're doing a cash flow, and the first thing to remember is you're looking at the differences, the increases between right here. So you'll have a balance sheet here. You've got a balance sheet of 2011 and a balance sheet of 2012. You're looking at the differences right here. Those are the things that you're looking at for the, is that going to let me draw? Oh, wow. Here you go. These are what ends up on the cash flow over here. You're not going to worry so much about the amounts, the full amounts in the accounts. You're worrying about the differences, how it's, you're going to analyze each one of those differences to come up with what to put on the cash flow. I think that made sense. So let's begin. So first of all, we are taking net income, and what we're doing is reconciling net income to show how much cash increased from December 2011 to December 2012. When you get this all done, the net increase, okay, in cash should be able to be calculated down through with all of these changes. So let's kind of begin. First, you have your net income, which was on the income statement. It gave it to you $1,012,400. So that's our benchmark. We add back depreciation. See, what you're doing in this situation right here is adjusting for non-cash transactions, because we're looking for cash flow. Depreciation is a non-cash expense. It's a paper loss or a paper expense. No cash is used in the transaction. So I have to add that back in. I have to look at the increase in accounts payable. These are all called working capital accounts from here down. And they're very liquid. And they're all involved with the income statement. So if I have an increase in accounts payable does not use cash at this point. It is a sales item. So that means this increase of $1,700 is in sales. And that's a non-cash item. There's no cash that is involved in that yet because they haven't paid it. So I have to deduct that. The same thing with inventories. Inventories eventually end up being an expense. And if I use previous inventory, that means there was no cash that passed hands for that inventory in this period. So that has to be added back in. Increase in accounts payable. What do we use accounts payable for? Expenses, right? So if that increased, accounts payable increase, that means there are expenses in this net income that there was no cash involved. So I need to add that back in. And then a decrease in a liability is just the reverse. So now I have to deduct that $1,800. If I add these all up, I get a net of $28,400. So that is added to the net income, and I end up with net cash provided by operating activities of $140,800. So this is what was provided by operating. Now let's concentrate down here and look at cash flows for investing items, and that would be buying land, selling land, purchasing equipment, everything that we would use to invest and to create, or for resources to run the operating expenses and to keep the whole plant running. So if I purchase land, that's an increase in land, but with decreased the cash flow, okay? So we've used cash on that. So that cash was used for investing. We purchased equipment, and this is kind of finky. Let me show you. If I bring this over here, can you see this? We have purchases, wrong one. No, it should be there. Let me see if I can move it. Oh, come on. Now it's stuck there. That's not good. I'll get it unstuck. So if you look at this, and you look at equipment right here. See the equipment right here. Okay. One of these amounts has to have this depreciation put back into it. They used because that's a non-cash and that affected that account. So we have to take that account to where there was no non-cash involved in it. So what they've done, okay, so you want to see if they purchased equipment, and you want to see how much, and you want to take the depreciation out of the picture. So they have taken $92,700 and subtracted the depreciation expense, and that gives them $78,500. They've subtracted that from the ending balance for 2012, and the difference is $22,400. So there's been an increase in equipment, and that's been a use of cash of $22,400. I very easily could have added that amount back into the $100,000. So it's a here or there, whichever way you want to play with that. So we've subtracted that and gotten it out of the way on either side of the equation. So now we add those two up and come up with a use of cash. We spent $47,100 on investing. So that will eventually be subtracted from this. This is what came from operations. We have a positive cash flow from operations. We have a negative cash flow. And now we're going to look at financing activities. And they tell you right up front, there is no sale of land, there's no issuance of notes payable, there's no retirements of stock, and there's no treasury stock. So all we have to worry about are dividends. And if you look at, right here, retained earnings, how we figure retained earnings is net income added to the retained earnings, and then you subtract dividends. Well, if I add these two together, it does not come up to $38,300. So they must have paid a dividend. This is how you analyze the accounts. So now you go, okay, $5,700 plus $112,400 does not come up to $38,300. So if I subtract that $38,300, I'm going to come up with the amount of dividends they declared and paid. They paid on a note. A note went down. If you look at the scheme again, if you look at notes payable, went down $27,000 right here. That ends up right here. They issued common stock, and you can tell that by the fact that common stock went up. $23,800. So that gets put here. So that's an inflow. These two are outflows. If you net those two, they had an outflow of cash of $83,000 for financing activities. So these two numbers will be subtracted from the positive, and you will come up with a net increase of $10,700. That will be added to the beginning cash balance and come up with $26,000, which should be the ending, or the beginning, so to speak, for 2012. See, we reconciled it. And it balances. We have 26,000 here, and I have 26,000 here. So I've reconciled my beginning cash to my ending cash, and I guess I could say the ending cash has been reconciled to the beginning cash for the next year by using net income and looking at operating activities, cash flow for that, the cash flow for the investing, and then cash flow for the financing. These are tricky simply because you have to analyze each account. So I hope this has helped somewhat.